All right, so welcome to another video. Today what we're going to do is we're going to chat a little bit about trading straddles and strangles. And the big question is it smart to do straddles and strangles during earnings? A lot of people want to get into straddles and strangles because they think, hey, if I go ahead and put these, I'm looking for a move one way or the other, and it's probably going to work out just fine. And that's how a lot of people start out with those things. So that's what we're going to talk about in this video. Keep in mind that these are recommendations to buy, sell, or trade anything, just my opinion. And if you want to grab some of those opinions, check out the Traders Fly website. You can see some of the live classes that we have going on and coming up. There's things on covered calls, adjustments, single options, portfolio construction, you name it. There's a lot of great things there. And you can also go ahead and also check out the Discord channel where I post some of the charts here as well, that you could go ahead and look at some technical analysis for the charts. Okay, that is in the link in the description if you want to sign up. Anyway, let's go ahead and take a look at straddles and strangles a little bit on earnings and just overall straddles and strangles. So the point behind a straddle and strangle is really you're looking for a movement one way or the other, and you're setting up an option trade where you're looking for that stock to either move this way or that way, up or down. And the really big thing that you get in trouble for is the time decay problem. So the way that it functions is, let's say I'm looking for a trade on Microsoft right now. It's kind of right around the $280 price level. We've got earnings coming up on 4/26. So if I'm looking to set up a straddle or strangle, what I would do is go into Microsoft. So here I'm going to type in Microsoft. So the earnings again, about 4/26. So let's say we go through earnings. So that'll mean I do an 11-day option. I could even go maybe an 18-day. And you could say, okay, well, let me go ahead and buy an option contract here. So by buying that one, I could have a nice move to the upside because I'm buying a single call. Now, what happens if it goes down? Well, I lose. Well, that's where the other side comes in, and I go ahead and buy this one and buy this one. And now I've got myself a straddle. Okay, so now I've got both ends, a single call and a single put, ready for the stock to kind of explode to the upside or the downside. So now a quick shout out from our sponsor. If you're on information overload and you can't figure out if you should pull the trigger on a stock, then go ahead and check out VectorVest's stock analysis report. It's absolutely free and rates every stock, whether you should be a buyer, seller, or hold the stock, given the fundamental analysis and technicals. So that way you can make smarter and wiser trading decisions. You can check out VectorVest by visiting vectorvest.com or seeing the link in the description below. So this may seem like a great idea or strategy in theory and in concept, but the reality is this strategy is actually a little bit more problematic. And I'll share with you why this is a little bit more troublesome. A lot of beginners like this concept or this strategy because they think, okay, well, as long as it moves up or down, the most I could lose is the most you pay on these spreads. But these spreads are actually very expensive because you're paying about $8 to $10 on a spread right here that's kind of right at the money. Because those are very expensive. Now, they're not deep in the money, but they're very pricey. They're not out of the money. However, they do have a chance of working out. But here's the issue. You're buying two right at the money, which have a very fast time decay. So if you look at, switch this column and you go to the Greeks and we switch it to the theta, and now we take a look, the fastest theta decay, it kind of works like a bell curve. So the fastest theta decay is actually going to be right here. So take a look. You're losing about, let's just call it 25 cents of decay, whereas over here you're losing about 3 cents of decay, and over here you're losing 21 cents of decay. So the biggest decay is actually happening right at the money, which is where you're getting your spread. So in fact, the ones that you're buying, you have the highest and fastest time decay. So that's a bit of the issue with some of these spreads. So if you look at this spread, I've got a 50 that I'm losing in theta. So I'm losing $50 a day just on the theta. If I just do just a single option contract, you can see I'm losing about $25 a day. But remember, if I get the put side, I'm losing 25. If I get the call side, I'm losing 25. So in total, that's why I'm losing 25 a day. So I'm losing twice as fast by getting a straddle or kind of a strangle. So I could widen this out, and that's what makes it a little bit more of a strangle. Okay, so here, and now I can widen it a little bit further. But now the movement starts becoming a little wider. Yes, I pay less for the spread, but I have to actually go further out here or here to making it work. The other thing that you have to watch out for is you got a big positive vega here. And with volatility, once it compresses or drops, which usually happens after earnings, you lose a lot of that premium. Right now, there's a ton of premium baked in here, but the minute earnings comes out, this line will actually drop. So that is a bit of a problem. So when do straddles and strangles actually work well? It works well when, number one, there's a couple of things. Number one is when the option prices are cheap because you're buying options. So when we are looking at the VIX and we are at the lower end on the options, this is a good time to buy options, right? When you're at the lower end of those spreads. The other thing, or when they work really well, is when you get an explosion of a move that's greater than the expected move. So either to the upside or to the downside. So when we look at, let's say, Microsoft, okay, the expected moves are over here on the side. So you could see 8 points, 16 points, 19 points at different durations. So it could be in 4 days, we're looking for an 8-point move. 11 days, we're looking for a 16-point move. And in 18 days, we're looking for about a 19-point move. So if I'm doing something, let's say May 6th, okay, I'm looking for about a 20-point move. So the way that this trade profits is really if I go maybe 30 or 40-point move. So I need to go beyond the expected move to really make it viable and make it worthwhile. Otherwise, that theta decay just eats it up. Otherwise, if these were easy strategies, everybody would just kind of put them on and do them because, hey, I'm looking for an explosive move. But these trades really profit more so when that explosion or move is greater than about 20 points, greater than the expected move. So a few days into these, okay, just take a look. We got 10, 20-point move, okay? And as you take a look at this 20-point move, look at where you're going to be. You're going to be right at break even, right? And then here we've got 10, 20-point move right here. There's your break even, okay? So my break evens are those red hash marks right there. So that's kind of where I need to go. I need to go beyond the expected move. And the expected move is that standard deviation curve. When we're looking at it, it's that bulk part of that where the movement normally happens. It's one standard deviation. So I have to go beyond that single standard deviation to really make this trade kind of profitable because I've got theta working against me. And if I'm trying to do this through earnings, I got vega against me because this vega will collapse. So every single day, even if I just stand still, let's just reset this trade. I'm going to go in and say, hey, okay, 1 day, 2 days, 3 days, 4 days, 5 days, 6 days. About 6 days into it, I'm already down about $500. And if the stock just kind of wiggled around over here, I'm still down $200 here or $200 there. So I really need it to move. I don't really care where it moves, but I really need it to move one way or the other. And in either case, that's what makes this trade a little more dangerous is because you're stacking a lot of short theta or negative theta against you. And if you're new to trading options and you don't know how to manage or control this theta, it can actually be a disaster. And if you're trying to run this through earnings, it can also be a disaster because you've got a lot of the vega that's positive and running it through earnings. After earnings, what happens is the volatility will compress, right? It'll deflate and you lose a lot of that vega or a lot of that premium that's baked into the option. And all of a sudden this line, which you'll see, if we go to it and I go into this gear icon over here, okay, now watch this profit and loss, what's going to happen here. Okay, so let me unlock the price. Watch this profit and loss. If we compress this vega and I start reducing that vega, look what's happening to the profit and loss, okay? That line, that white line starts getting closer to that green line and I'm losing more and more money. So if we get a compression of volatility, you'll be down 270 just from the volatility. Plus, let's say a few days later, you're down $400 or $500 just from that as well. So you need to be very careful when doing these trades because of those couple of factors. So in other words, these trades work well when number one, you move beyond the expected move. Number two, you don't have a volatility collapse like you would through earnings. So when the VIX is cheap, that's a good time to buy options because what you're doing is you're buying 2 times the options that you normally would. You're buying them at the money, which is kind of the worst in theta. and it works against you. But if the stock has been moving sideways, like let's say the stock's just moving sideways, not doing anything, and you're like, hey, we're either going to really rip higher or we're going to really break down, that's usually when you put these trades on. When stocks have been just kind of moving sideways, or you're thinking, hey, it's really going to tank or it's really going to explode up, that's the time to put on these trades. But they have to move beyond the expected move, which is usually the general move, right, that they're budgeting for. So if it moves beyond the normal, then that's how and when these trades profit. Other than that, you've got time against you, volatility is against you through earnings. And it can be problematic putting these positions on during high volatility movements, because you'll actually have a volatility collapse and it can actually work against you. Because if you're thinking, hey, if the market's whipping around like this and I buy these, you're buying the most expensive options. So be more careful with trading these kinds of strategies, because a lot of people don't understand how they function and behave. Those are some tidbits and tips for you to give you some thoughts on trading these straddles or strangles. And they are vehicles that you need to be a little more careful of, because of the theta, the premium paid, and just overall understanding how they work and behave is a little more on the advanced side than what most people are comfortable with. So anyway, I hope that helps. Thank you so much for joining me. Truly appreciate it. Enjoy the rest of the week ahead. And if you have questions, reach out on our website. You can also book a one-on-one coaching session if you're interested in working the strategy together and masterminding it through. And I can give you some more tidbits and insights on what to watch for when dealing with situations like this. You can get that insight on our website at tradersfly.com. Thanks again, and I will see you in the next video.